Hello everybody, welcome back to another episode of Real Talk with LoukProp. And recently, I saw a comment on our Seneca Residence review that said that it was strange that I rated Amo Residences the same score as Seneca Residence, although one was clearly better than the other, with the justification that Amo Residences recently did much better in terms of their sales percentage at launch. And that got me thinking, does a better rate of sales definitely equal to the project being a better project? This is what we're going to be discussing today, and at the end of the video, you might be surprised with the findings. Let's go. But before we get into the video, let me try to directly answer to the comment and explain how our real reviews work. Now, for viewers who have been following our real reviews, you will know that we do our reviews based on these 5 factors, and for each factor, we'll give it a score between 1 to 5. At the end of the video, we'll add up all the scores and give it an average score upon 5 as well. Now, of course, every person that buys a property will be doing it for various reasons, right? It could be for own stay, it could be for short-term capital gains, long-term value preservation, it could be for rental use, so on and so forth. So some factors would matter more than other factors for you, which is the reason why we want you to be able to look through the entire video, know my opinions on each factor so that you can make an informed decision. So our projects A and B may get the same overall score. Some factors may rate higher for project A, while other factors may rate higher for project B, and they even each other out. Now, it doesn't mean that projects A and B are equally as good for everyone. It just means that you have to look at individual factors to know which project is better for you based on your individual objectives. Now, with that out of the way, let's get back to the main topic. So, is it really true that a fast-selling project is definitely a better project to buy? Now, do note that for this video, we are purely looking at a capital gains perspective, and to make it a fair comparison, we will be choosing projects that launched within a similar time frame and also a similar project size. Let's get to case study number 1. Now, for the first case study, we are looking at 76 Shenton. Now, 76 Shenton is a 202 unit large project. All right, it was launched in April of 2010, and as you can see here, within a month of its launch, from start of April to start of May, about 90% of the total project was already sold out. Within 2 months, the whole project was fully sold out. In terms of its price, let me zoom in a little bit. You can see that it started off at around 2,024 per square foot as an average for the launch prices back then. In 2023, right now, the average prices are at 1,940 per square foot. So you can see the project didn't make much. In fact, it lost a little bit of money. And to be very specific, the number of profitable transactions since 2010 were 43 transactions only. And the unprofitable transactions had a total of 22 unprofitable transactions. That's already half of the profitable transactions in the project. Now, the project we are using to compare to 76 Shenton would be Parvis. This project was launched in November of 2009, just a few months before 76 Shenton. The total unit size is 248 units. Now, if you were to compare, within the same 1 month period from 19 November, we can see here, up until 17 to 21st of December, only 38% of the project was sold within 1 month. This project took a total of 1 year to fully sell out, so a lot slower than 76 Shenton. But let's take a look at the prices right now. If you can see here at launch, it was launched at an average of 1,649 per square foot, and in 2023, it has gone up to 2,061 per square foot. That's about a 400 per square foot difference in price. So a slower performing project like Parvis as compared to 76 Shenton actually did better in terms of capital gain potential. We can also see that the profitable transactions for this project is 91 transactions and only 4 unprofitable transactions, which is really good. So for the second case study, we are looking at Echelon. Now, Echelon was launched in 2nd of January 2013. It is a 508 unit large project. And as you can see, from January of 2013 all the way to July 2013, it only took the project 7 months to fully sell out the entire project. So that's pretty fast for any project during that period of time. So now taking a look at the prices, Echelon launched at an average price of 1,768 per square feet. Okay? Now in 2013, you can see that the average pricing is at 1,985 per square feet. So that's roughly a 200 per square feet profit margin for Echelon. In terms of its profitable transactions, you see a total of 89 transactions. And in terms of unprofitable transactions, you have 27 unprofitable transactions. So in 2013, what other project can we compare it with? The next project we'll be comparing with Echelon is Thomson 3. Thomson 3 launched in September of 2013. And if you see here, if you see a type of sale here, right, new sale, from 2013 all the way to 2015, it took them about 2 years' time to fully sell out the project, when Echelon only took 7 months. So comparatively, it is a much slower project in terms of rate of sales, but let's take a look at the prices. Thomson 3 launched at an average price of 1,344 per square foot, and in 2023, right now, they are actually averaging at about 1,820 per square foot. So that's close to a 500 per square foot capital gain potential. And as compared to Echelon's 200 per square foot, you can clearly see that there's a big difference in terms of capital gain potential over the years. Now, taking note that Thomson 3 is a 435 unit large project. In terms of profitable transactions, you already have 104 transactions that are profitable and only 1 unprofitable transaction. So by any measure, you can see that Thomson 3 performed much better than Echelon, although Echelon is a much faster selling project. In fact, there are many examples of slow-moving projects that made a hefty capital gain for their owners. So for example, the Poise Residences. This project, in the first 2 months, only sold 45% of its project, and it took a total of 3 years to fully sell out the project. But you can see that there's a total of 143 profitable transactions and 0 unprofitable transactions. Similarly, Principal Garden sold only 24% in the first 2 months and took more than 2 years to fully sell out the project. This project had a total of 115 transactions and only 1 unprofitable transactions. And may I add, can you look at the profit margin on Principal Garden? You have as high as $1 million in terms of profit margin. That's a lot. Clover by the Park sold only 43% in the first 2 months and took a total of 3 years to fully sell out the project. It has 285 profitable transactions with profit margins that could be as high as 1.1 million and a total of 3 unprofitable transactions. So you can see that fast-moving projects may not mean that it's a better project, and slow-moving projects can still make you a good capital gain over the years. I can show you an entire list of projects that can perform in the same way as what I've just described to you just now. Now, I can already hear some of you through the screen, right? Louis, your analysis is too simplistic, right? You can't compare like that, it's not fair. You are cherry-picking projects. Some projects may be doing better because of its location, because of price, because of facilities, so on and so forth. And you know what? You're right? That's exactly what I've been trying to say throughout this whole video, right? Many factors go into determining whether a project is good or not. And something as one-dimensional as saying that project A is better than project B just because the rate of sales is higher is a little bit too simplistic and doesn't tell the whole story. So if you are curious about how I do my analysis on projects, check out the Real Reviews playlist below for a rough idea of how I do it. Or if you would like a full analysis on a project of your choice, leave it down in the comment section below or contact us for a discussion. Hope this video was helpful for you, and if it was helpful, please like and share the video. Most importantly, please subscribe to the channel to get more real estate content, and it will help us out a lot. It's Louis from LoukProp, and I'll see you in the next Real Talk video. Bye! Cardi? Okay. Whew. Let's see some snacks. This one last packet at the grocery store. Sells so fast, must be very good, right? Okay.